Hey everyone and welcome back to CryptoScores.com. Today we are covering three metrics that go hand in hand: derivatives pairs and volume, derivatives over market cap, and derivatives over spot. These three together tell you how active the speculative side of a project's market is and whether that's a good sign or just a warning. First, let's have a quick reminder. Derivatives, futures, perpetuals, options are contracts that track the price of a token without actually buying or selling the token itself. When a token has an active derivatives market, it means professional and active traders are involved. They use derivatives to hedge positions, manage risks, and speculate on price movements. So the presence of derivatives is generally a sign of market maturity. It means exchanges have put in the effort to support the token and traders take it seriously enough to build strategies around it. But, and this is an important point, derivatives also amplify volatility. Leveraged positions can push price up or down much faster than spot trading alone. Let's take at BitAnswer and Tao as an example. With a pretty good liquidity score 93 over 100, if we scroll down, we can see the three metrics over there. 65 derivatives pair with $2.67 billion in daily volume. No special color, transparent. That tells you the derivatives market is active and here healthy. 65 pairs means the token is available across many platforms for leverage trading, and 2.67 billion in daily volume shows real interest from active traders. Now, the derivatives over market cap ratio, 80.32%, highlighted in green. This ratio compares the derivatives volume to the project's market cap. At 80%, it means daily derivatives volume represents a significant chunk of the entire market cap. Green here tells you there is strong speculative interest relative to the project size. Active traders are heavily involved, which typically brings liquidity and tighter spreads. If, at the contrary, this ratio were in red, it will signal the opposite. Very low derivative activity relative to the market cap, meaning the speculative layer is thin. Less professional interest, potentially less liquid, and possibly less mature as a tradable asset. And the derivatives over spot ratio, 404%, transparent, normal range. This one compares derivatives volume to actual spot volume. At 400%, it means 4 times more money is being traded on derivatives than on the spot market. That's actually not unusual for an actively traded token. Derivatives markets are typically larger than spot, but it's useful to be aware of. And when this ratio is very high, it tells you the most of the activity around this token is speculative positioning, not actual buying and selling of the token itself, and short-term traders dominate. For long investors, it's good to know. And if this were in red, it will mean derivatives activity is very low compared to the spot. So the speculative market barely exists, which could indicate limited professional interest in the token. And for these three metrics, you can click on it and go to CoinGecko to see the details, which exchanges offer derivatives, what the volumes look like on each one, which pairs are the most active. As always, the link is right there on CryptoScores. So how do you read the three together? Active derivatives market with healthy ratios, the token is taken seriously by traders and exchanges. That's generally a positive signal for liquidity, but keep in mind that high derivatives activity also means higher volatility potential. Leverage traders can amplify movement in both directions. Green tells you strong activity, transparent is normal, red means something is lagging and that's worth investigating before you commit to that project. As always, with CryptoScores, you are the analyst. Use these signals as part of your big picture. Derivatives, the speculative layer that tells you how seriously the market takes a project. Check all three metrics on CryptoScores.com and we will see you there in the next one.